Greetings to my beloved lecturer. Before I continue to my storyline, I would like to introduce my group members first. My presentation is about government bonds. Let's be a better Malaysian to know about the government bonds. Do you know what government bonds all about? In a simplest term, governments around the global issue securities, keeping in mind the end goal to get cash to help pay their bills is known as government bonds. There are two types of bonds, which is US and UK bonds. Mainly we would like to talk about US bonds. US is also called as treasuries. Let's move on to buy the bonds. How to buy the bonds? Do you guys have any idea? There are few ways to buy government bonds. One of the way is buying directly from the US Treasury. To buy Treasury bonds directly from US, you must have an account in Treasury Direct, which means you have to open an account. By buying for a bond in Treasury Direct, you have to agree whatever yield is determined at auction and guarantee to receive the bond you want in the amount you want. Besides that, submit a bid in Treasury Direct. The bid submission process in Treasury Direct is completely online. Log into your account and click the Buy Direct tab and follow the steps that I've mentioned in the online regulation. Third way is payments and receipts in Treasury Direct. The price that you pay for a bond can include either a premium or a discount or an accrued interest. For a full discussion of the price of a security, see Treasury bonds rates and terms. When you buy a bond in Treasury Direct, we withdraw the purchase price from the source of funds that you specify, which could be one of your bank accounts or your certificate of indebtedness. When the bond matures, we deposit payments into your bank account or your C of I, whichever you specify. Last but not least, buying through a bank, broker or dealer. Bank, brokers and dealers offer two types of binding for bonds. First, competitive. You specify the yield you will accept. Depending on what yield is determined at the auction, you may or may not receive the bond you want. And if you receive it, you may receive in it less than the amount you want. Second, non-competitive. You agree to accept whatever yield is determined at auction. You are granted to receive the bond you want in the amount you want. Let's give a break, guys. I know it's too boring. Let's watch a video about the government bond, which may tell about the government bond in better way.
A bond is basically a loan. An entity such as a company, a municipality, or a country needs money and issues a bond. That entity is obviously called the bond issuer, and the amount of money it receives is called the principal. It receives that money from another entity, intuitively called the bond holder. Maybe a person, perhaps a company, or why not a country? Of course, the bond holder doesn't just want the principal back from the bond issuer. He also expects interest on top of that, also called the coupon. And finally, it is clearly stated when the deal between the two parties ends, or in other words, what the so-called maturity date is. However, unlike with loans that you make to friends, for example, bonds are financial instruments that can be bought and sold on the open market. Let's assume Max made a $15,000 loan to his friend Jack. If Max ends up needing cash quickly for an emergency, he can of course ask Jack to pay him back sooner. But if Jack cannot do that or refuses, Max won't have many options left, especially short-term ones. If Max would have, for example, bought German bonds with those $15,000 instead, he could have simply sold them to another investor to get the short-term capital he needed. As can be seen, bonds are highly liquid, but this doesn't mean they're safe. If the bond issuer goes bankrupt or something very bad happens, you can lose everything.
There are few criteria for purchasing the government bonds. First, bond prices have inverse relationship with market interest rate, and it's a relationship that will generate capital gains or loss. Second, movement of interest rate and capital or loss profits. Third, change of revenue and credit quality. And lastly, the role of rating agencies in measuring credit quality. These are the criteria for purchasing the government bonds with easily. So, we can use these criteria for purchasing the government bonds in our future. Let's move on to our first criteria, which is interest rate and bond prices have an inverse relationship. I have shown an example, which is if the interest rate increases, the bond prices will be lower, but if the interest rate is fall, the bond prices will increase. So it shows that bond prices and interest rate have an inverse relationship. These are the example of the second criteria. And lastly, I would like to give an example to the fourth criteria, which have been shown in this video. Other issues. Government bonds also have pros and cons. Let's look at the advantage of government bonds. Firstly, the risk is usually relatively low compared to equities. Second, bonds can be an excellent diversifier as they frequently perform well when other asset classes perform badly. Lastly, bonds are liquid and early redemption is easy as bonds are bought and sold on the open market every day. The disadvantages of a government bonds is the interest paid on bonds or the yield can be low. Second, bond can lose value on the open market if the interest rate or inflation expectation rise. This is because higher interest rate or higher inflation make the fixed interest paid by bond less attractive. Thirdly, long-run returns tend to be lower than for riskier assets such as equities and property. Bonds can be vulnerable if the government that issues them enters a fiscal crisis that raises doubts about whether debt obligation will be honored. Although government bonds have advantage, but it is really good for us to know about the government bonds or buy about the government bonds for the future. The next part that we're going to discuss is the role of government bonds in portfolio. The main role of the government bond is as a diversifier in low-medium risk or medium risk portfolios. Second, government bonds values tend not to move in line with equity values, which can help to reduce volatility in a portfolio significantly. Lastly, government bonds may also prove useful for those who plan to use their pension fund to buy a guaranteed income for life or annuity. These are the role of government bonds in the portfolio. Although I discussed about what is the bond, criteria, the way, the advantage, disadvantages, you all will think, although we buy bond, what will we get? How to get profit? So, I would like to discuss about the profit, how to get profit on government bond. The profit is, it depends on the government that issuing the bond on how much they will put it. Not only that, the bond maturity also depends on the government to decide it. But in generally, the less stable the issuer, the higher the interest rate it will pay. That's because the issuer has to make it worthwhile to investors, given the greater risk that a less stable issuer will divide on its payments. Furthermore, bond yields are a measurement of an annual return to investors who buy government debt. Just look at the example. Bonds are part of investments and known as fixed income securities. However, these securities are debt obligations, means one party borrowing money from another party who expects to be paid back with interest. If we bought a 10 years bonds with a coupon rate of 8%, the issuer will send you interest payment of 80 every year. In addition, most bonds pay twice a year, so we would receive 2 checks for 40 each. Same goes to the example 2.